Let's bring in Rick Rieder. He is BlackRock's CIO of Global Fixed Income. He is also the head of their global allocation team. It's good to have you.
Thanks for having me. Appreciate it.
So let's start big picture, right? We're talking about 100 days of this administration, 100 days in which the markets have not acted, I think, how most thought they would on January the 20th. Is that the same for you?
Yeah, I mean, when you come in each year with a game plan and a strategy, this one's been a little bit different. And listen, I mean, I think I've said on the show with you before, U.S. economy is actually incredibly stable. Very rarely goes into recession. It takes an exogenous shock to create it. And now we're going through this period of what's pretty extraordinary uncertainty. And we've got to get, it's interesting when you listen to corporate earnings, a lot of pulling guidance, a lot of trying to interpret where we're going, and you go through this earnings season and, the data we have through March 31 for companies is interesting, but it's not terribly revealing about where we're going. It's a little like, know what the economy did before the internet. Interesting, but things are changing and the uncertainty is still high, and the uncertainty by industry is incredibly high. The uncertainty by regional, how companies think about cost of goods sold, their distribution mechanism, the logistics, et cetera. So it's a pretty unusual period of time.
I mean, does the president's trade war and these tariffs, does that qualify in your mind as the exogenous shock that you now worry would send the economy into recession?
So, Scott, that's a great question. So I think the U.S. economy ends up pulling through quite nicely. But the question of how long does it take, and the question of, China's a really big deal, 145% tariff on China. The flow-through effect to much of the economy is pretty darn significant, and inflation on the backside of that. That is a pretty significant influence on where the economy is. I think the U.S. economy will be fine. In the next 2 months, or the data we'll get for April, May, and June, you could go through a pretty significant downturn as companies pull back and say, we're going to wait. As consumers say, you know what, I'm a bit fatigued by price. I'm a little concerned. I'm going to wait. And so I just think, whether it's a long-term recession, I don't think it will be. I just think you could have a little bit of a pullback here where you have significant near-term growth deceleration as people just say, you know what, I want to wait.
I mean, so you're describing a short and shallow recession if we have one in your mind. That's basically what I take from what you said.
Correct. Although I'm not, it's a question of how shallow is shallow. I think it tends to be short. And then I think as you get in the second half of the year, then, the things will evolve. We'll get through some of this. It's the uncertainty that is so hard. Markets hate uncertainty. CEOs hate uncertainty. It's a question now of pullback and then see where we go. And I think once people get clarity, even if the tariffs ultimately end up being the effective tariff rate, let's say it's 15%-ish, U.S. economy can withstand that. Where it is regionally, where it is by sector, there'll be some real dispersion, but I think the economy can handle it, and then I think the second half will show better results.
You sound, I don't know, perhaps a little more sanguine, maybe more positive than I would have expected, just given where we expected to be and where we are and the amount of fog, so to speak, that's still in front of everybody's eyes?
So I would say a couple of things. First of all, I've learned in my career, sometimes you got to operate through the haze. And usually there's better money generated when you're in the haze because of you got to take some risk. I mean, if you go back a week or two ago, people were buying. We were selling puts on the S&P, on banks, and it was incredible what people were paying for insurance after the hurricane. Now I think you've got valuations that, quite frankly, if I had to put a letter grade on where we are today, C-. I don't think these valuations are very exciting. I think people are generally negative, and the technicals in the equity market are pretty good. So could we push a little bit higher? I have to say, if you said we're pricing in earnings growth of 8%-ish, you're pricing a 21 multiple off of that, those valuations are not attractive. But the technicals are pretty good. So I would say, we are, today, I actually like selling some of the upside in equities versus where we were a couple of weeks ago. But the technicals tend to win, and they're definitely pushing the market higher than valuations would suggest.